it's like Buffett and Munger always used to say. If you can buy the S&P at 25 times earnings, you do it because it's the deal of a lifetime.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I am joined as always by the brain trust himself, Mr. Chase Taylor. I mean, markets were down, but kind of nothing crazy. Kind of a I don't want to say boring day, but compared to recent events, this would qualify as boring just because nothing crazy happened. But give us a little rundown. I guess we'll start there and get into the particulars. Give us a little rundown of where we finished on the indexes and rates and all that stuff.
Yep. S&P closed down 0.77. NASDAQ 100 down 0.94. Equal weight was down a little over 1%. Small caps down a little over 1%. Equal weight down 0.75. Mag 7 down 0.89. The rest of the world, ex-US stocks were down 0.16. Another day of outperformance there. Oil up 3.4%. Gold up 3.3, up $109 on the day after basically up $100 yesterday. So monster 2 days for gold. Silver also up 3, even platinum and palladium were up over 3. The dollar down 0.57%. And I thought that it looked like the dollar could be bottoming just very short term, but now it looks like we might be breaking below the little support that was building there, which is a huge deal to me. 2-year yield down 5 and 10-year yield down 4 basis points on the day. And then you had front month VIX futures up about 3%. You're back to 23.9 there. So we've never even gotten really close, particularly close to even 20 even. Notably sticking higher in the vol regime.
Yeah.
And 2 down days in a row after, 9 up days in a row in the market.
Yeah. Which 9 up days in a row, I think is the biggest winning streak in 20 years, something like that.
Yeah. It was like 04 or something like that. I can't remember what it was.
It's funny when you say that out loud. If you told me that occurred, and then if you asked me to describe the market and what events took place, literally, I would probably describe a market the opposite of what we currently have, or I would guess bear market rally.
But what's funny is like I definitely think of bear market rallies as vicious rallies, like sharp, big rranlies. But I don't think I think of them as like the market goes up every day for 2 weeks, you know?
Yeah, I know.
That's kind of intense.
Well, you had
Granted, some of those were small, but
you had one 10.5% ripper though.
Yeah, that was not a bad day.
No,
I don't think that was in the 9 in a row. I think we had some down days after that, and then we just had that weird just let's go up every day move.
Yeah. Well, you know, if you're looking at it via the perspective of flows, I don't think it makes that little sense, right? You and I have talked a lot about how you'll watch the markets move really big one way or the other, you know, depending on what that marginal buyer or seller's doing, right? You get done with that kind of first wave of what I think was, you know, international liquidation, right? It settles down, flows pick back up. I mean, look, we know that for a variety of different reasons, flows being one of them, passive being another, that, you know, the US market is as fundamentally blind as it's ever been. And so it's really, you know, it's hard to, I think it's hard to put too much meaning on these moves one way or the other. You know what I'm saying? Like, you know, retail's in there buying, like what'd you say? You listed a stat today on our investment call that kind of blew my mind.
Yeah. Marcos showed it. It was from Bank of America's like private wealth clients showing the most like days or weeks or something in a row that they had been buying, and it was by far the record.
Yeah.
So I mean, talk about days in a row. There was your days in a row from, you know, non-institutional investors just pounding the buy button. Generational opportunity because, you know, we were down a few percent on, you know, a negative GDP and massive trade war, but whatever.
Well, it's like Buffett and Munger always used to say: if you can buy the S&P at 25 times earnings, you do it because it's the deal of a lifetime.
Speaking of, they're not really buying anything yet,
No.
which is notable.
No, he's what did that cash pile get up to? 350 billion.
It's so it's such a big number. It's just hard to wrap your head around.
It is talk about dry powder.
Yeah.
The other thing too, it'll be interesting to see what Abel does when he takes over, because I would assume that it would. I know Buffett's we've talked about this before. I know Buffett's stance on it, but the fact that you won't take 5 to 10 billion and go buy up some of these gold producers, like everybody's like, oh, he hates gold. I know, I get it. Yes, I get it. But there are no bad assets, just bad prices. Like he loves cash flow.
Any sort of screen you would do from a value perspective, it would pop.
Yeah,
that I do know.
Yeah, and you don't. And the beautiful thing about him, if you don't like the businesses or whatever, take them private.
And he did own like Barrick there for a while.
Yeah, but but it was a small position, so that way it had to be either Abel's or the other guy. Well, I'm blanking on his name.
But yeah, just take out the top like 3 market cap ones and just roll them into Berkshire Mining or whatever, right?
Yeah, you made a really good point. Yeah, Berkshire Mining. And I think there's massive opportunity there on the uranium. So really anything that needs to be mined right now, generally speaking, you can find unbelievable deals compared to the overall market.
Right.
I mean, you can find unbelievable deals in anything mining just on an economic basis. You'd think he'd be all over that. But I don't know. The other one, and I brought this up too, I just keep thinking, why would he not be pulling the trigger on Google?
Yeah, that one's even more curious, honestly. I can understand why someone would avoid the mining business, but
yes, I get that too. And to be fair, I wouldn't want to play, if I was him, I wouldn't want to play the equity side of it. But what I would do is I just go make tender offers for some of these and just go buy them out and just let the cash flow fund build my cash pile back up for me. You know what I mean? That's the way I'd play it. What did we see on rates today? Did you already discuss rates?
Yeah. 10-year was down about 4 basis points.
Okay.
And there was a good 10-year auction today. So, and people were super like, it could go either way on that, given the Taiwanese dollar stuff. Like you could have made the argument that they would have to get in and buy treasuries, and you could make the argument they would be stressed into selling them. So, not that one auction is going to be end all be all on Asian Forex, markets, but solid auction. And then you could see a big tone shift in rates once that went through. But we actually had Atlanta's GDP now go back up from like 1% to 2%. So that made it a little interesting to me that you had a pretty decent day on the long end, given that the growth estimate popped back up to 2%. But it's still so early in the quarter that those things, I mean, it moves by 1% at least every time they update it. So
we haven't talked about this a lot, but when I see these pictures of empty ports, we all know overreacting and flipping out and jumping to conclusions in this business is how you'll get run over. So but when I look at those pictures of the ports, I'm looking around going, how could you have any positive growth with what you're seeing at ports? That is a head scratcher to me.
It's counterintuitive with the way GDP works. The net import thing was the reason. Yeah. But with the Atlanta GDP nowcast popping up to 2, that's not not a huge deal. And that thing's very noisy. It's probably it though. I'm sure the net.
It has to be that
is part of it. And I can look at the breakdown of each component and see.
But these are conditions that actually scare me more. And the reason why is because of the unique setup that we're currently in. You could be getting serious damage underneath the hood, and on the surface, it's not going to look like it.
Yeah, there's a lag that I think is there, and plus we've hammered this, but you front ran, so like yes, the ports are empty, but that's after they were busy, and they were busy for a few months.
Yeah.
So part of it's just equalizing, but at the same time, part of it is more than equalizing, and as soon as this next jobs report, you can see like the truckers and warehouse workers and rail workers and like start to feel it, start to get hit. and that's a big deal. Not to mention, construction too of the last 3 months for residential construction has been negative. So like those are not small inputs into
No,
the way the economy works. So
no, they're not small at all. Yeah, it's.
And speaking of, Besant today said we have not had trade talks with China. They've kind of made it sound like, oh yeah, we're talking, it's cool. But today he's like, okay, we have not.
Something that again, that we talked about on our investment call that I keep coming back to. When I look at what's going on in DC, we were talking about the budget process, right? The what is the term for it? Reconciliation. Yeah, reconciliation process. You look at how much, the degree to which both political sides are dug in. As is always the case in our history, I think that we'll get these issues dealt with and resolved to some degree. I just don't think you can do it with markets here. Yeah, and people are like, "What do you mean?" I'm like, and you've pointed this out before. If markets continue to do well, it takes so much pressure off the administration. And I think people really are looking past this because the stock market is not what it was 15 years ago. And I'm not talking about structurally. I'm talking about even the role it plays, right? Politicians are so much more aware of the stock market and its performance. And the way that the public uses that is a report card, right? And wrongfully so, in my opinion, as a short-term report card on policy, right? That I don't think that you have the political will to really do anything with the yield curve where it's at, the stock market where it's at, all of those things. I see us dealing with these issues and coming to resolutions. It's really hard for me to see, for instance, I don't know, and I haven't gone through the numbers, but I don't know that, can Trump get this budget deal done with no support from the left?
No.
Okay. So
the left will offer no support for this. It has to be done with, they can lose, I think, two or three votes in the House, and that's it.
Now, if the S&P is down 20% year to date and you're losing control of the long end, they're going to use that to crush Trump, right? They're going to use that to go after Trump. At the same time, Trump's going to be out there saying, look, they won't pass a budget. They won't do this. They won't do that. I think literally all actors will be pressed in to making the correct or more correct decision, however you want to frame it. Unfortunately, I just don't see it happening without the stock market significantly lower than it currently is. I think you've got to have that impetus. I just don't see anything else that's going, because here's the deal. And this is the way I think the stock market has changed. Neither side wants to wear the label of crash in the stock market.
For sure.
Right.
And especially the bond market.
Yeah. Especially the bond market. And so I mean, we all know what we all think on a fundamental level and all that kind of stuff, but just, again, even just playing it on game theory, you look at it and go, yeah, I think they're going to get the stuff done that they need to get done. I just don't see the impetus to get it done until things look dicey.
Yeah. One of the things I talked about in our meeting today was like, to me, it's starting to look like this reconciliation deal, which has the tax cuts in it and a bunch of other stuff, is starting to look pretty dicey, pretty tough. They're not even beginning to make progress. And there's these chasms between different sides that are, I mean, they're big. And I just put these two things together in my head. Like on a day like today, especially well, the bond market did better than I would have expected given like the GDP upgrade and stuff. But if you think about it, if it starts to looking more and more like that package will fail, the bond market will love that because that package is going to make the deficit worse. So if they struggle to pass essentially fiscal stimulus, and we keep high tariffs that bring in revenue and lower the deficit, like bond market will love both of those things. The bond market will be like, oh, like that, now we're actually going to talk about bringing the deficit in, not the way you wanted to, but still. So I think the bond market starts to become, as you know, we're kind of hitting crunch time the next 2 months on this bill. Um, the bond market starts to become more than anything, maybe a proxy for the odds that they pass something close to what Trump wants. I didn't have thought about it till now, but that's probably kind of one of the reasons it's doing well today. Is you read into how things are going at Congress, and it's like, oh, this is not good. They can't really agree on anything.
Yeah.
And I
Yeah.
shouldn't say Congress. The Republicans within themselves can't agree on anything because it's it's just up to them to get this thing done. So
Well, and you've got some, I'm sure, on the Republican side of it, they want deeper spending cuts. They really want to, like,
yep,
I hate using the word because it takes me back to 08, 09, but they really want a harder form of austerity.
right. So the Freedom Caucus was promised certain amount of cuts to move the deal forward. The only place anyone was able to find a place to do real cuts was in Medicaid. And then obviously you have a bunch of people in Congress who are like, whoa, I'm not cutting Medicaid. Like, I'll lose my election. Like, I'm not doing that.
Yeah.
And then so some people are like, well, then we'll just make the states pay way more of their share of Medicaid. And then like people are like, yeah, no, like that will crush my state and I won't get elected. So like those two sides are definitely facing off. But I would say the flip side of this, let's say 6 weeks from now, they've patched over some of these problems. They're getting close. And it comes down to whether or not the Freedom Caucus caves and just like, whatever, like, we don't care if we fund these tax cuts, let's just do them. For whatever reason, they give in. That's where you see, I think, the bond market do the opposite, where you have the 10-year yield just skyrocket on unfunded tax cuts, blowing out the deficit.
Yeah.
And I have no idea which way this goes. All I know is right now, it just looks like it's going to be tough for them to get something done. And they're aiming for, at first it was Memorial Day, and now they've kind of said 4th of July. So we'll see how it goes. And raising the debt ceiling is also in this package. And that X date on whenever we run out of money is it's not that far away. So that's going to get interesting too. That whole thing's going to get pressure packed this summer.
Yep. The other one, we talked about this too, but boy, that bounce back in gold was, whew.
Yeah.
From a guy that's paid attention to that market for a really long time. I've never seen, I'm trying to think. I don't think I've ever seen action quite like this, where you get slammed. I was fully expecting us to go down and test 3,000.
I thought we at least had to go further than this. This is the second pullback in the last year that just bottomed out way before I thought it would, or frankly should, like, because the sentiment positioning stuff is still, you just didn't burn that much of it off. But yeah, I mean, you essentially took out 2 days worth, or within 2 days, you took out like 2 weeks worth of slow falling. Just monster 2 days.
Yeah.
Today is the highest daily close you've had. Now you got up, a good bit further on that nasty reversal day. But
geez, I didn't realize we had as good a day as we had.
Yeah,
we were up almost 100 pips.
Yep.
Wow.
Well, gold being up 3%.
Yeah. That's sure.
Yeah. Some of the ex-US stuff. I mean, so you have the S&P kind of stuck between the 200-day and 50-day. So kind of in no man's land. You go look at VEU, the ex-US ETF. It's way above, comfortably above all of its moving averages. Like, it's fine.
Yeah. It's interesting the way our portfolio, because we're basically at the highs that we've been at this year for our portfolio. Meanwhile, the stock market's still considerably off its.
Yeah.
Which you'd expect. And that's that trend that we've been talking about. Like, you're going to see these sharp rallies that I think suck people back into US stocks, but you just keep going back to the drawing board. And
it wasn't even the dip to buy.
No. And you look at I've said this, guys, by the end of this year, I could be proven wrong, right? I am fully aware of that. And you're never, from either of us, you're not going to get, neither of us are those kind of guys that think that we're the only ones that can get the trades right and we never mess up and all that kind of stuff. But I'll just continue to go back saying it. I think the thing that most investors aren't looking at, and I'll go back to my Tyson and Steve Urkel analogy, right? Like, I just don't understand why you'd want to sit there and try to make bets on whether the U.S. is going to squeeze back to cycle high multiple expansion when you can literally go buy stuff for just freaking pennies on the dollar everywhere else. I just, it doesn't, it just doesn't.
The amount of countries trading below 15 times is staggering,
Oh,
and no one cares.
and no one cares. Anecdotal, but not really anecdotal. Tell you're trying to put together a sheet. Or you wanted to get together a sheet so you could look at these countries in order and see where their valuations are. And yet that sheet didn't exist.
Yeah. So I track 45 country ETFs, and there's no easy way to see what now, obviously in a country ETF, it's just a different grouping of stocks, right? So you can kind of find the average PE ratio of it. And then you can look at that country's actual stock exchange to get the PE ratio. The thing is, like, there's no clean, easy way to find that, like, group together where you can, like, just look at it on a dashboard. So I literally had to hand jam a spreadsheet for all of this. And that, to me, like, as I was doing, I was like, this is in itself a bit of a signal that no one really cares about buying these ETFs, or like they're really investing ex-US just in general. If I have to make, hand jam this thing with multiple sources.
Yeah.
Yeah. So, and building it though has been eye-opening with just how cheap so many of these countries are. I mean, I've hammered home about Greece and Brazil and stuff. Greece has been on fire for 3 years, and it's still under 10 times earnings. Jeez. Like there was another one that was pretty surprising that has just ripped lately. Oh, Singapore. Singapore has been a phenomenal place to have money the last year or two. Same thing. Like the valuation is like 11 times or something. And that one just stopped me in my tracks. I'm like, really? After the run we've been on, it's still this cheap? Like, shocking.
Yeah, it is shocking. And the thing that's more shocking to me is watching U.S. investors still trying to go back to the it's inexplicable to me. I don't really understand. I don't understand it.
I had a research client reach out because I got very negative on Liberation Day, and I had a client reach out like, see, that was actually a buying opportunity. I'm like, yeah, it was, but look at all the countries that are crushing the U.S. since Liberation Day. It was a buying opportunity, just not here though.
Well, that was the argument that I got, not an argument, but got into a spat on Twitter about this. I was on somebody else's podcast. It's a real big podcast in this area. It's a lot of subscribers too. But anyway, one of the listeners on there sends me this DM and is like, yeah, way to get everybody to panic. And I'm like, bro, we're at the highs of the year. I don't know what you're talking about. I said specifically, don't panic and blow everything out. But I just said, hey, everybody's and their mother. If you look at the average retail portfolio, no exaggeration, just 100% U.S. stocks. That's what you are.
Yep.
Right. And you own the largest amount of the Meg 7s and the stuff that's the most expensive. That is what it is. And the point that I was making is I go, guys, that has only been widely accepted in the construction of retail portfolios literally in the last 5 to 7 years. Right. And it is not a product of long run research. It is a product of professional risk. Period. The U.S. market was the only market running. And so what you watched, now on one side of it was the right thing. I was the guy screaming from the rooftops as early as 2011, get out of bonds. I just thought it was the worst risk reward setup I'd ever seen. And it ended up being the case, which should come to a surprise to nobody.
Yeah, it really should. Yeah.
Well, I mean, that was just, people have given me credit for that call. And I'm like going, dude, rates were at zero. You're right. Like, this was really simple.
Yeah, and Congress got the biggest checkbook in the world out.
Yeah. So, I mean, let's, my investment thesis is I want you to pay me 1% to manage a bond portfolio that's yielding 3%, which net of expenses means you're yielding less than the inflation rate with yields at 0, waiting for rates to go up. Right.
And speaking of, Switzerland might cut back into negative rates soon. And I think some of their front end bonds are actually trading negative again.
Oh, wow.
I thought we were done with all that. So at least in Switzerland, maybe we're not.
Wow. That's wild. I thought that
they get a ton of safe haven flows and they don't want them.
Yeah.
So like they try to like basically just get everyone to go away by running their monetary policy that way. But
yeah, getting back to so anyway, so what I was saying, he's like, oh yeah, way to freak everybody out and sound the alarm. And I'm like sitting there going, we're up 7 on the year, man. Like I did not say that. I said you need to drastically reduce your US exposure and you need international exposure in gold. And I'm sitting there going, we were saying that at the beginning of the year. I've had bad calls before, but there's no part of that that's bad. I mean, that has been the call, right? I mean, that's been the play.
100%.
And I think we were sitting there saying bad things are going to happen. I think these people are, oh, that means you're advocating to sell all stocks. Well, except for the fact that I said don't sell all stocks, right? Like, and this just goes to, that was another anecdotal example of how myopic the average investor has gotten, right? Just there's only one market. Guys, that is not the case. It has never been the case. And if you go back now, this is funny because as a guy that's raged against modern portfolio theory my entire life or my entire career, there is something to be said for this, meaning there is incredible amounts of data about the smoothing nature of including international equities and emerging markets and metals into an overall portfolio. Okay. What you just went through in the last 15 years is not a new normal. It's the anomaly. Okay. We're getting back to new normal. And I think a lot of people, especially in the US, are going to learn a painful lesson about why we diversify global equity risk.
Right. Diversification is not sprinkling in some, staples instead of just tech.
Right. US staples,
right,
by the way.
Right. It's going abroad. It's going into commodities and real assets.
You bring up a really funny one. Okay. So the run into staples. Okay. The reason why I think staples are interesting is sort of like the comps we've made on airline companies. If you're a legitimate staple, doesn't really matter if you're US based or not. Right. I mean, I think everything domiciled in the US, I would feel more comfortable investing in it. Right. We've got the deepest markets, the most liquid markets. But staples are kind of, I don't want to say unique in that way, but kind of commodities. You know what I'm saying? When you look at the spread, when you look at the valuation spread between US and international staples, you're looking at 3-4x difference in valuation.
I mean, you can buy BYD, which is an elite technical car company, for way cheaper than you can buy just American staples.
Oh,
and their profit margins, their growth are just completely off the hook.
Yeah,
meanwhile, you can buy Johnson and Johnson for 30 times or whatever. I don't know what it is, but
yeah, yeah, I again could be wrong, but I really like my chances, and I sure like the way it's shaken out. What else we got?
One thing I just want to mention was Axios had an article today about the fact that the administration is trying to fast track new nuclear reactors, which provided some support to the uranium and nuclear space. Good news we expected to see, but still nice to see. Apparently there's an executive order that's going to come out before long along those lines. And uranium and nuclear has been, it's had a very tough 2025 and really back half of 24 into 25. So nice to see that. And nat gas I wanted to mention because it looks like U.S. oil production has peaked, and I think that's going to be enough to get associated gas production. So the gas production you do just right alongside oil, it just happens to be with it. Whenever you shut that oil well, you also shut down that gas production. So like that might put a bigger floor under gas than we were expecting for the rest of the year, as long as oil prices stay down low enough to where oil production keeps rolling over.
It's funny when you bring up uranium. The best move we might have made as far as performance goes this year was really downsizing our exposure to uranium coming into this year. And we didn't want to do it.
No.
But looking at that, because it got smacked. URNM,
pretty big drawdown.
Yeah. Wasn't URNM north of 55? Not that long ago. Yeah. But you went from 55, 60-ish range down to 30. It got smoked for 40 or 50%. That would have
in a pretty long, it took a while too. It's not like it went straight down in like a month and then V-shaped or something. Like it just kind of grinded its way lower for a pretty long time.
Yeah, that was a rough ride.
And one last thing that I looked up today that caught me a little off guard was I mean, I think we all know, like we talk about passive all the time. All the money that's in 401ks, IRAs. There's just as much foreign money in our markets than there is U.S. based retirement money, and that's when you think about like a flow standpoint and a possible perspective flow standpoint of what could happen if trade and just call it international relations in general were to deteriorate and enough people took enough money home. It's I don't know, like this is spooky how much money is invested here that's not ours.
Well, and one of the things that I don't think is widely appreciated enough is we're not just making a valuation or even a tariff argument, right? If the dollar has broken its uptrend, which I'm not prepared to sit there and say definitively it has, but it looks like it could have, right? I mean, it certainly could have. You have multiple reasons for international money to come back
right
out of the U.S. markets. It's not just a valuation story.
And they create feedback loops.
Yep. It's a growth story, right? It's a valuation story. It's a currency story. You got all the reasons. Again, I'll just tell you, man, if I'm wrong, I'll wear it like I always do. But, I'll go back to what we were saying. They don't ring a bell at the top. I'm pretty sure they just did. Relative, at least on a relative basis, right? Again, you and I'll stick. I know you and I both agree on this. Neither of us are sitting there predicting, the U.S. market to fall into a giant morass. That's not what we're predicting. But just on a relative basis, it's as a guy that manages money, I'm not anti-U.S. Not by any stretch of the imagination. I would prefer to have a board set up where I could be 80 to 90% US for a whole host of reasons, right? I look at the board, the way it's set up, you can't bring yourself to do it. It just seems foolish, reckless. Especially with what else is out there, man. So what else do we have coming up this week?
Oh, we got the Fed tomorrow, and that's really about it.
And they're not going to do anything.
No, but the commentary around kind of how they're looking at the next couple months will definitely be important. Although we're just at a point in this cycle where, the international stuff, the tariff stuff, the fiscal stuff is just so much more important than what Powell has to say. But it's still, we'll still carry the day tomorrow.
Yeah. And if we've learned anything, Fed days can be pretty wild.
Yep.
And
that may be the day you finally get some VIX to be able to chill out, right?
Yeah, wild and seemingly nonsensical too. And I'm not really sure why that. Probably just because so many people are making bets coming into that day. But
right,
we've just seen
a lot of hedging flows that come in that have to get unwound. And my assumption there is, just it's more like, we don't really have to do anything right now. Like we don't know which way that's going to go, so we're gonna watch for another month or two.
Yep.
It comes down to jobs data and inflation data. We'll watch both, and we'll let you know.
Yeah. That seems to be where we're at. All right, guys. Well, just to keep reminding you, you can find us on YouTube. Just get on there and search for Know Your Risk Podcast. We're on TikTok, Twitter, Facebook, or no, what were we calling it? It's Instaface. Instaface, yeah.
That's the Bill Belichick version.
Yeah, Instagram.
For those going at home.
Yeah, Instaface. We're big on Instaface. Big followers there. Anyway, you guys know the drill. Again, we're doing videos so you can see our pretty faces looking at you. But that'll do it for today. Have a wonderful evening. We'll be back again tomorrow. Doing a podcast. Going to be on Trevor Hall's podcast tomorrow. Talk gold miners. We're going to do a little home and home. He's going to come on ours and
awesome.
Talk some gold miners.
Good people.
Yep.
Nebraska's finest.
Yep. Trevor Hall was at that dinner I did with Dimitri down in Phoenix.
He was in Argentina as well. So
oh, really?
I just saw him recently.
Yeah, he makes the rounds. That guy's put a lot of boots on the ground.
That's for sure.
And I'm really excited to talk to him about producers because he
and he was there talking about the mining ministry and went out to some site visits and stuff in Argentina. So yeah,
he knows his stuff. So anyway, we got all that stuff coming up. We got to dial in that. We got Brent on the schedule now. We got Kevin Muir on the schedule. It's coming. We're finally getting into that the interview stuff. So Brent will be fun to have on. I haven't spoken to Brent. I spoke to him briefly at that dinner down in Phoenix, but I haven't had him on the show in quite a while. I'm really interested to hear his thoughts on the dollar.
Yeah, because Kleenex for his dollar bull tears,
Yeah. Yeah. We'll see where he's at. Anyway, guys, that'll do it for us today. Have a wonderful evening and join us tomorrow. You're listening to the Know Your Risk podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.